Hello, welcome to today's lesson. In today's lesson, we learn about financial statements, their preparation and adjustments. If we reflect on sole proprietor accounts, the final statement of sole proprietor are the first one is the income statement, and the other one is the balance sheet. These are the final accounts of a sole proprietor. The income statement usually report the profit or loss of the business, and has two categories or two steps. The first step is finding the gross profit, while the other step is finding the net profit. So when you want to find the gross profit, or the gross profit is found by an account that we call trading account. Whereas on finding net profit, we prepare an account that we call profit or loss account. The balance sheet report the financial position of the business, and we call it statement of financial position. Statement of financial position. It reports the financial position of a business at a particular point, maybe in a year. If we now start analyzing the two final statements, starting with the income statement, let us check on the gross profit analysis that is done by trading account. So the trading account will give us the gross profit of the business. And how do you get the gross profit? Before you even get the gross profit of the trading account, how do you get profit in any business or any transaction that you're doing? Whenever you have a transaction and you want to get profit is given by the selling price minus the cost price. The value or the selling price is the price that you put to sell to the consumer. The cost price, these are the costs you have incurred when securing or purchasing the product that you're selling to the consumer or the customer. So now we want to get the gross profit for our trading account preparation. The selling price now represent the net sales or the sales that you have. So this one represent the net sales or the sales that you make in the business. What about the cost price? The cost price represent the cost of sale. The cost of sale, the cost of those products that you are selling, the cost you have incurred to make sure that you have those products in your business so that you can sell them, and get this net sale. That's a cost we are referring as the cost of sale. If we further do an adjustment on the net sale and cost of sale, this is how we'll do them. For the net sale, we have the net sale. These are sales. Who do we sell to? We sell to the customers. So the customers are the one we sell to. The net sales usually have, if for instance we sold an item and it is returned by the customer to our business, then we call that sales return. That's an adjustment to the net sale, and it will reduce the revenue that we had gained from the selling. So the net sale will be given by the sales, the revenue that you'll get, you less sales return or return inward. We call it return inward. This is also the sale return. What about the cost of sale? Cost of sale comprises of three parts or three things. The first one is the opening stock. When you're talking about cost of sales, you're talking about purchases. Purchases. In the purchases, we have the opening stock. What is the opening stock? Opening stock is a stock at the beginning of our financial year. And that opening stock was the purchases that we made previous year, but some remained and we carried it forward to the current year. So that is, and in this year we have remained with it. So probably the selling of this opening, the closing stock of the last year is on we have as opening stock, which now we can sell in this year. So that is the opening stock. When you have the opening stock which is borrowed from the previous year, the current year will add from to the opening stock new purchases. Yeah, so that's another number 2 item of the cost of sale, the purchases that we have purchased this year. At the end of year, that's number 3, we may not have whatever you have bought this year additional to what we had from the previous year, that is opening stock. Probably will not sell all of it. So there is some stock that will remain that will carry forward to the following year. And what will carry forward to the following year, we call it the closing stock. This one will not be used during this year. This is a purchases of this year, but will be used or will be sold next year. It has remained. So that we call the closing stock. Those are the 3 parts of the cost of sale. And we have the 2 parts of the sales, that is sales and return inward. In here, the opening stock, purchases and closing stock. Purchases have its own adjustments. So if you adjust purchases, that's number 2, purchases, we adjust it so that we can have all the costs related to purchases in the current year factored in. How do you do that? So if we continue now, if I just plot this here so that we can have a link on that, we want to adjust purchases. When adjusting purchases, what are the costs that were related with purchases this year? 1, we transported goods that we bought to the business. So that one lead to a cost we call carriage inward. So addition to purchases, so we have another cost that we earned, carriage inward. That's a cost of transporting the product or the goods that you have purchased to the farm. The other cost that will be added in the purchases is freight charges. This is, for instance, you imported your product, so you have the freight charges. What are the other accounts that are involved in this? Probably after purchasing your product to the business, you have identified some products that are not fit for sale, so you return them. So another adjustment here is done to the purchases, and this is it reduces the purchases. Whatever you sold, if you return some product to the supplier, then you reduce that because it's not part of what you'll sell. So you'll reduce, so you less return, purchases return or return outward. That's what we're calling the purchases return outward. Another thing that could have been adjusted in purchases, if it is there, probably you have used some stock you purchased for personal use. So if you have done that, then that one reduces the amount of stock that's available for sale. So what is that? That is stock drawing. You reduce it. It will still be reduced from the purchases. Stock drawings. Hope you have understood our adjustment here. From the cost of sale, split into 3 accounts: opening stock, purchases, closing stock. Then adjusting our purchases to the carriage inward, freight charges, that's supposed to be added. Then there's something to be deducted, that is done outward, and stock drawings. So at least at this moment now we see, or we find ourselves finding the gross profit. So if now I put it in an equation here, it shows that our gross profit will be given by the net sale, and our net sale, if you put a bracket, it is sale you less or you subtract return inward. Then all of these you're supposed to less what? You're supposed to subtract the cost price, which is cost of sale, and the cost of sale comprises of the opening stock, purchases, and the closing stock. Before I get to what to subtract here, I'll assist you in categorizing the three. That is opening stock, purchases, and closing stock. When you have opening stock and the purchases, remember the closing stock is what to be sold in the following year. So it's not part of this year's sales. So first of all, let us take number one, number two, opening stock and purchases. Opening stock and purchases including its cost, related cost that we have analyzed down here. It is what is available for sale in the current year. So we have goods available, cost of goods available for sale. Cost of goods available for sale consists of this. It consists of the opening stock. You earned purchases, and purchases you are adding together with its adjustment. So you are adding as well carriage inward, you are adding as well freight charges, then subtracting return outward, and subtracting another item, stock drawing. All these, that's what we're calling the cost of goods available for sale. When you have these, then then you less the closing stock, that's what we get is the cost of sale. So our equation here could be the opening stock plus purchases, you less the closing stock. That's what we are calling the cost of sale. Opening stock plus purchases, you less closing stock. And our adjustment of the cost of goods available for sale, it is up to the point of opening stock and purchases. So what are you supposed to do? You're supposed to less the cost price, which will be now our cost of goods available for sale. If we put in a bracket here, cost of goods available for sale less closing stock. So this is how we can get the gross profit. If we get the cost of goods available for sale, that is opening stock plus purchases and its adjustment, then you less closing stock. Whatever we get, then we less from sales, you less return inward, then you'll get our gross profit. Now let us arrange it in the form of a structure. We prepare a trading account structure and we arrange them in a systematic way, and you'll find where each and every entry, that's every account, is factored in. Let's get to the account. So let's call this business of this trader ABC trader. So what are you preparing? Trading account for the year ended. Let me just give this for the date and the month on which we are doing this account. So this account will have 3 columns. three columns. Start with these three columns. Now we can start our analysis, and we said our gross profit is given by net sale minus cost of sales. So we start with the net sale, then we adjust the cost of sale. So net sales is given by, first of all, the sale revenue. So sales, at the end column there. Then what is adjusted net sale? We have already said it's being adjusted by return inward. Return inward, or what the customer have returned in the business. Probably it was not well packaged, probably was not the standard of the customer, and have returned. Then what you are getting here is what we are calling the net sales. That is it. So we have already adjusted this part. So we need now to come to this other part. So, and what are we doing? We are subtracting. So we less cost of sales. Let us now start adjusting. We have said the cost of sale comprises of three parts. That is the opening stock, purchases of the year and its adjustment, and the closing stock. And this is how we arrange them so that we can get a good analysis and find our gross profit. So cost of sale, we start with the opening stock. Opening stock, and this will put it in the middle column. Reason is, I would like to put the other adjustment of purchases in the first column so that I can adjust it. Then at the end of it all, to get the cost of goods available for sale, it's given by the opening stock, adding purchases. Yeah, so I would like to get this adjustment of the purchases, then I add it to the opening stock. So we start with the purchases. First of all, you have the purchases, the stock that we purchased. Purchases in the middle, in the first column. Then you adjust it now. And purchases, we have said another adjustment to the purchases is the carriage inward. Yeah, we transported these goods to the farm or to the business. Carriage inward. You add it. What else to be added? If, for instance, you imported, we have the freight charges. Then we have other to be considered, like if you had returned some of the product to the supplier, you'll subtract it. So we will subtract return outward. Another thing to subtract is drawings. If we had done some drawing on the stock, so stock drawing, whatever we have, we do the summation, then we put it on this side for addition with the opening stock. It's opening stock, we add it with the adjustment that you have done. I'm putting in bracket to indicate is a subtraction. So now we have whatever we get after we add opening stock and purchases and its adjustment. This one here, we call it cost of goods available for sale. That's what we have. Getting back to our equation, that there is one part which is remaining now to get the cost of sale, which is the closing stock. Remember, the cost of sale, we have said it's opening stock plus purchases, then you subtract the closing stock. So you have to subtract closing stock here to get the cost of sale. So closing stock. subtract from this amount. Then whatever you're getting here, it is the cost of goods, it's a cost of sales. Yeah, this is a cost of sales. This is what we're calling the cost of sales. And now to get the gross profit, we said gross profit, it will be given by net profit less cost of sales. We already have gotten cost of sales. Gross profit is given by net sale. Net sales give less cost of sales. So now we have net sale on top there, and we have the cost of sale down here. So now in the final column, whatever we get the cost of sale here, we will now transfer it to the final column. And then we less it. So we less it, or we subtract it from the net sale. Net sale, you can see it there. The net sale, then we are adjusting the net sales and the cost of sales to get our gross profit. So the value we get down here, this is what we are calling the gross profit. It could be a loss, so stroke a loss. But when it is a loss, then you can give it a bracket if it's a loss. That it could be the case. So that's how you prepare the trading account. Hope you have enjoyed. In the next class, we will learn about the preparation of the profit or loss account. Then you combine it with the trading account to get the full income statement. Then from there, we'll give you an example, and from that, we can see how to solve a problem related to income statement. Thank you for watching. Remember to subscribe to our channel, so that we can have more classes for you. Thank you very much.